Terrific. Everybody's on time from our attendees' perspective. Thank you very much to the shareholders of PayGroup joining today, and also visitors to the story. We're really appreciating of your time. And as I noticed that the pre-registrations are pretty much equal to the attendees, we'll get started. Joining me today for our presentation is Elise, our Group CFO, and Sachin, our Chief Commercial Officer, and we'll take great delight in presenting you our full year presentation and results for FY22. Shareholders have seen this slide before, but just for a reminder about what we're strategically achieving on behalf of our client base is to assure our clients that they get one view of their workforce across the geographies that they engage with PayGroup. Regulatory compliance is key to what we do, and we're very focused on making sure that we're timely and accurate around the payroll transactions we create, as well as the last mile advantage, but also increasingly assuring our customers as they use our SaaS, particularly our HCM modules, that we can help them grow and expand for the geographies that they want to. So we are keeping our clients and assuring them of compliance when it comes to their workforce across the globe on a daily basis. We have to say also, in addition to that, that we are creating a significant monetisation opportunity. You can see that our SaaS platform and our SaaS and services are processing over $11 billion in pay slips annually. That creates a great monetisation opportunity for us. And as a result of that, Sachin will describe how that's tracking, improving, and creating a great contribution to PayGroup. Our growing revenue is matched to our profitability, and very delighted to announce our maiden full year profit. We have 95% client retention in the group, and that's matched by our 3-year contracts with automatic renewals. And therefore, we're assuring ourselves growth each year as we layer new clients on top of our existing run rate. So, in fact, our clients often are our best sales force because they're mechanically growing in our regions that we operate. So the how we service our clients is simplified on this slide. In previous presentations, we've given our shareholders a view of all of our modules. That's pretty well understood here. But this is how we're solving regulatory issues as well as digitising our clients' HR processes. And that's on the right-hand side with the talent management solutions. We're seeing with the Great Resignation and the ability for people to move through different jurisdictions with their one employer, that managing your employee from a hire to retire perspective is becoming extremely critical. That talent management solution now interoperates with all of our sectors that we operate, the 3 verticals of franchise, corporate, and contractor. So that integration has been successful. We continue to focus our upsells with our account management group and our operations team around our extensive solutions. I mentioned before around the $11 billion of payroll transactions that we create through our SaaS and services. It's important to note that in our ARR for that particular area, less than 5% of our clients take on payments today. So this is a great upsell opportunity, and we have built a leader to assist us with that upsell, and we'll further describe that process in the deck. Our talent management suite that's fully integrated with the rest of our platforms now is leading in about 11% of our increasing sales funnel. So the ability for PayGroup to have acquired that product suite as well as to integrate it is now proving a strategic selling difference. And of course, we present this all to our clients from a position of trust, whether it be the global headquarters or a regional headquarters. That's how we sell, and that's how we present our solutions. We'll keep you regulatory and compliant. We'll assure your payments of your people and their superannuation funds, so that creates a high level of trust. And in fact, again, on that thematic of trust, 24% of our sales in FY22 were actually upsells. So that's showing the mechanical upsell and the improvement of the share of wallet for each of our clients. Reminding ourselves that we have a 95% retention rate, and you're seeing that these world-class companies, where we're focused on selling, certainly brand names, we're not going down the chain of SME, we're staying very focused on enterprise and brand. And all of our customers here get our SaaS platform. All of them get our SaaS. And a very big focus on the bottom left-hand corner in our contractor segment, that's where they're exclusively using our SaaS. And in corporates and franchising, they're using our SaaS plus service. And our franchise solution set has been merged with our corporate solution set. So now over 20% of our implementations for franchise organisations are not Australian. So we're seeing that leverage continue of PayGroup's 82 country network into the franchise sector, which is delightful. The delivery models can, beg your pardon, Sachin, thank you. The delivery models can actually be focused on SaaS only or SaaS and service. Following our agenda along, we'll work into our financial results and give a commercial update, and then I'll close with a stat, with certainly an outlook. So our shareholders have seen how we measure ourselves at PayGroup and our management level and what we're focused on. And here is our core focus areas. The growth areas, we've been focused on revenue and assuring that revenue is delivered with increased level of profit. And the interoperability of our platforms where we've integrated has been challenging, but we're winning there and we're seeing those cross sells. And therefore, as a result of that, revenue has certainly increased. Our EBITDA position is fantastic, and we'll concentrate and focus on EBITDA as well as our NPAT, and that leverage that we're getting day in, day out from a growing client base over a relatively existing operational expense will assure shareholders that as we step through into FY23 and beyond, that our focus on EBITDA and NPAT and creating a profitable organisation beyond this is our management's core focus. This year, we've had a full year of organic growth, obviously no acquisitions. We're focused on cash profitability. And just as a reminder, at this point in time, we don't have any information memorandums in front of our board around acquisitions. So we are delighted with our technology suite. We're delighted with our service map. We're delighted with the 82 countries that we can offer our clients, and that's where we'll continue our focus to leverage in FY23. We have some normalisation that Elise will take through in this particular fiscal reporting period, and that's typically one-off consulting fees, a mediation expense, and obviously from a revenue side, we close the IWS transaction 1 month into the year. So there'll be 1 month of normalised revenue as you see Elise's information being presented. I'd like to pass to Sachin. The sales organisation, the commercial team have been outstanding in FY22. So congratulations to Sachin and his team. And away you go, please.
Thank you, Mark, and hi, everybody. Good morning. Just continuing from the theme of what Mark was referring to in our strong growth. So we've always presented our ARR in, definitions of it is the exit run rate as well as our signed but unimplemented customer contracts. Not only have we had fantastic sales growth, 22.5 million in contracts, 64% more than FY21, but we've also had fantastic growth in our speed of how we take a signed contract and put it into go live and recognize that statutory revenue. And we are very pleased to also present today what portion of our ARR is already in the statutory revenue and the exit run rate as we recorded in accounting terms, and the percentage that's in our implementation positive backlog. So ARR growth is 44% on last year, noting that it's all organic. This does not account for any acquisitions, as the IWS acquisition was already put into the FY21 ARR number. The reason we've had such great growth is across all pillars, and that's direct sales team selling fantastically in Australia, Asia Pacific, the Middle East, and of course our global partner program, which we'll touch on upon a bit later, which represents 31% of our sales for FY22. So how we've broken it down for you, 81% of our ARR is already recurring revenue in accounting terms. And that's 19% of the implementation, which is the 7.6 million you see there, that will implement throughout the course of FY23, because not every client goes live on the same day on 1st of April. And as we've mentioned before, the implementation is predominantly driven by client timetable and demands, not our inability to go faster. But of course, you know, we've also got plans to sell even more than we have in FY22, in FY23, and that will continue as a leading indicator of our ARR growth in the future. So strong sales momentum coupled with a lot of upsells and the GPP performing really well has given us a very strong base for ARR as we exit FY22. As we look into the buckets of ARR, we've given a further breakdown here. The key elements to look at here are, as I mentioned, the 31.5 million or 81% of our ARR is already live. And what's to be implemented is a mix of corporate, contractor, workforce management, and franchise deals that we've signed, as well as that whole treasury payments business where we've got a implementation view of when some payments are going live in FY23. So this is great visibility to show our shareholders how that whole ARR bucket is put together and broken down. Now, we've had a great strong sales year, but it doesn't stop our sales pipeline growing either. So a lot of the contracts in our sales pipeline in FY22 obviously came off it because we had record sales. But more has been put on the pipeline, and it's now 7 multiple of what it was 18 months ago. And we're very proud of that the combination of record sales and growing pipeline is a great, again, leading indicator of future growth. And I've just finished on mentioning again that the $7.6 million of contracts to be implemented, we expect them to be going in phased throughout FY23 as we book them in our statutory revenue. And the final point I'd like to make on our revenue and ARR is, we've mentioned this before, it is a great leading indicator for PayGroup. It is a trend of PayGroup. If you look at how we convert our ARR exit to following year stat revenue, it is a great correlation. And that is a great hallmark, as I mentioned, of PayGroup. And between FY21 exit ARR and FY22 statutory revenue, it's 100% correlation. And that, you know, I won't have to guide too many people here, as we don't give guidance this early in the year. But if you look at this correlation going in from year to year, it's how we expect our investors and our future investors to look at how we take our ARR into statutory revenue. Just reminding everybody again, the reason we can correlate so well is we have 95% client retention. Our lifetime contracts continue to grow year on year. It's now beyond 9 years of average lifetime tenure of contracts, continued record sales, and of course, delivering contracts to cash faster will help us to achieve our correlation year on year. I'll now pass on to Elise to take us through the statutory results for FY22. Thanks, Elise.
Thank you, Sachin. We continue to grow in FY22 despite the disruptions in COVID. We're proud of the fact that we delivered 68% of revenue growth in FY22 and delivered 27.2 million in revenue. Our exit ARR in FY21 was 27.2 million, as Sachin mentioned in the earlier slide, and we delivered on 27.2 million stat revenue. This, as Sachin said, demonstrates the predictability of our growth, and the efficiency in sales to cash implementation. Our revenue growth was contributed by 11 months of IWS, the acquisition completed in May 2021 calendar year, our growing GPP sales channel with zero sales and marketing costs. We added new partners such as SD Works during the year and will continue to leverage the growing partnerships in the coming years. Cross-selling continues to grow strongly, demonstrating the demand for our platforms. Our sales growth has contributed to a strong financial year. Gross margin was at 54%, and we continue to focus on growing with efficiency, realizing cross-business synergies and cost savings where we can to create operating leverage. Statutory EBITDA was 1.5 million. Normalised EBITDA achieved was 3 million, representing the strength of our underlying business. Normalised EBITDA includes 1.1 million of one-off costs and 400K of operating costs, being 1 month of IWS pre-acquisition. Our one-off costs included consulting fees, mediation costs, and acquisition costs, which we don't expect to reoccur in FY23. As Mark mentioned, we are very proud of our Maiden net profit after tax, which includes 1.5 million of deferred tax benefits recognised. We ended the year with a strong cash position, 6.2 million of cash in the bank to execute on key strategic priorities. Operating cash flow are in line with our strategy for growth, as well as achieving profitability and the foundation for long-term operating leverage. Investing cash flow is predominantly contributed by the IWS acquisition and investments in our technology platforms in line with our product roadmap. Financing activities primarily related to the capital raise in early FY22 and was predominantly related to the IWS acquisition. In FY22, we achieved significant reduction in our cash burn quarter on quarter. Generating cash flow positive is one of our key goals moving into FY23 and beyond. We continue to deliver on positive EBITDA with normalised EBITDA of 3 million, and one of our key priorities is to achieve long-term operating leverage and EBITDA growth. We are very proud of our full-year Maiden profit after tax. Management is focused on growing sustainably and unlocking future earnings potential. We recognise deferred tax benefit of 1.5 million in view of expected future profitability in the business. Management's key strategic priorities is to achieve year-on-year profit and to unlock operating leverage and generate positive cash. With that, I'll pass over to Sachin.
Thanks, Elise.
Thank you, Sachin.
So just, what has driven our financial performance, the strong financial performance? It's all about our customers. It's all about us generating more out of our customers. And the growth in our customer base is from direct sales. It's from signing up great recognized companies as Hudson RPO, Dexus, as you can see on the screen there. But we've signed a lot more, all across 3 verticals. And payslips growth doesn't always indicate only new clients. So we've also increased enterprise customers in terms of new logos, as we call them in our industry, but we've also increased our payslips and our transactions exponentially. And what that also reflects is selling more into the same customer. For example, monetisation. You all know about our payments business. We've spoken about it before, where we do cross-border, where we do domestic payments in 80 out of our 82 countries, and we don't do it in 2 because the government just doesn't allow it, and that's from memory, Saudi Arabia and Pakistan. So the upselling, the 24% upsell of sales in FY22 further increases the payslips and transactions, not only new customers. And as we know, how we generate our revenue is every new payslip for us is a revenue generating event, whether it's in services payroll, whether it's in SaaS HCM, whether it's in payments. We continue to look at opportunities for a greater share of wallet each and every single time. So just moving on to how we're unlocking that greater share of wallet and focusing a little bit more on monetization. As I mentioned, payments has grown really well. Our upsell on our strategic HCM modules to our corporate base has grown really well, and both have led to what we've got as 24% in our sales being upsells. On the right-hand side, you'll see a comparative there, and that's a real rapid growth in our monetization business, driven predominantly by our payments, as well as our reliable, recurring choice of superannuation monetization that we have in our Australian platform. Not only have we been able to generate more revenue there, but we've actually expanded that in the early stages into the franchise platform that we have, so that all those franchise employees who are onboarded, all the great realization, the great resignation that's causing more jobs to churn. So we don't lose that number of payslip, but the number of people who impact that payslip churn more these days, that creates more opportunity for us to monetize. And that increases our high margin revenue from that line of monetization. And just finally touching on the fact that we have launched accessing wages earned in one jurisdiction. We are going to bring it into Australia in half one of FY23. We are taking it as proof of concepts. We are taking it where we embed it into our platforms, as we are not going to be an enterprise that is known for doing any predatory loans. It is all about giving employee well-being to our clients' employees. And as Mark mentioned earlier, we've invested in our monetization and treasury business by hiring a head of monetization during FY22, and that's starting to pay dividends as we continue to grow in our payments and superannuation monetization and adding more and more employee well-being modules as we go along. And finally, to wrap up my whole commercial section here, Elise did mention that we had a fantastic signing of a new partner, SD Works. And just to give you a point of how big they really are, 76,000 customers across Europe. PayGroup is now their preferred partner in APAC and Middle East. We've already got the first contract from them last month, in fact, to implement. So the differentiator that SD Works brings as compared to some of our other partners is they focus on the upselling of the APAC and Middle East geographies in their embedded existing customer base. So not only is that slightly easier to sell because you're not always selling a new logo, it's the need for their customers to have the single view of workforce that we integrate deeply with our global partners as we push the data after we do all the payroll, the compliance, the lodgements and payments into the one view for their customers to have. So very proud of how 31% of our business, in sales in FY22 came from the GPP, adding SD Works at the tail end of our financial year. We are very excited of what that brings even more in FY23. And yes, it is a lower cost of customer acquisition for us across the GPP, because as you'll remember, the GPP partner is the one doing all the sales, the heavy lifting in contracts, and PayGroup is the beneficiary of the work to implement and operate in our jurisdictions. So very excited about what this growth channel brings to us in FY23. And we have, heard our shareholders, we've heard our investors, and everybody wants to compare us to the market and our peers. And we've been able to get to what we show you here is our strong lifetime value to our cost of customer acquisition ratio. With a target of just being over 5 being good, we're actually at 15.8. And what that tells you is we have a very lean and effective sales team. That sales team is performing extremely well as we do record sales year on year. We do invest in sales resources where we find good ones and where the geography needs it. As Mark mentioned at the start, we do a sell to a global or a regional headquarter. And of course, our direct sales team is also supplemented really, really well by our global partner program. So those additional sales driven by a large sales team of our partners impacts us and improves our LTV to CAC ratio. So we're very happy to be able to release this information, and we'll consistently, keep recording this. And as I mentioned, as we do find good sales resources, it's all about sales before expense at PayGroup. We will keep adding to the growing sales force that we have today. And just the loyalty economics that you've all seen before, just repeating the same thematics of why we have great investors, why we have great financial performance. We have an increasing average lifetime of customer. Now it's 9 years, going on 10. 95% customer retention, that's revenue retention. And to be honest with you, in the COVID times, we all know many companies have suffered. One example we always use, and it's something that impacted us from 98 to 95% from a half year to full year, is Oliver's. Unfortunately, they went into administration. So we also account for such events in our customer retention, which are out of our control. So really, it's a really proud moment of 95% customer retention, leading to loyalty economics, allowing the further trust from our client base into us, giving that trust an upsell opportunity, where 24% of the upsells in sales came from that. And then it drives further referrals, where we have our GPP giving 31% of our contracts, not just referrals, to our sales numbers for FY22. I'll complete there and hand over back to Mark to talk to you about our outlook.
Thank you, Sachin and Elise. So PayGroup, we as a team consistently excel against our strategic priorities since IPO. It's been well documented how we've been able to create each of these 4 operating aspects of our strategy plan into realised shareholder benefit. So we're delivering on organic growth, and that's because of the position that we have of trust within our client base and trust within our community to allow us to be able to build upon our talent that rapidly implements our sales contracts to cash. And our implementation team is growing, run by Chris Brunton globally, an outstanding execution in FY22 to assure ourselves that we have 81% of our ARR implemented going into FY23. We're seeing an execution and an increased uptake of monetisation. That's clear. It's 5% of our client base uses some element of that. And we've bolstered our organisation around treasury and monetisation during the course of the year too, with very experienced payments team members that will assure shareholders that uptake increases in FY23, and importantly, our clients are getting the value out of our monetisation, domestic payments, cross-border primarily, as our Australian client base internationalises. We've made investments in our platforms, that's clear. Those investments have realised we're ahead of the game in our technology roadmap, and investors will see that we will have a decrease in technology expenses in FY23 compared to FY22. That's because we're winning there, and the interoperability of the platforms, our centre of expertise, led by Murali in India, is allowing us to get the engineering talent to be able to achieve what our clients need from us and our prospects need from us in our 7x growth in our sales pipeline. So that's definitely something that we're executing on, and our clients are certainly delighted about that interoperability of platforms. We'll only realise operating leverage if we have the right team members in place, and certainly the right partnerships with our clients to be able to do that. So we are getting efficiency, obviously, from smart shoring where it's relevant. and certainly in some of the growth areas around processing, that's certainly very relevant. And our enhanced technology capabilities with improved modules and a focus on our modules on improving their time to implement will again make impact in FY23. But that's all about the growth in our team, the growth in our engineering talent, and importantly, how we listen to our customers as a customer-first organisation to realise what phases of the implementations that they would like to focus on for their business. And it's typically payroll, payments, and the ability to assure themselves that they're regulatory and compliant throughout the region. We're always exceeding on our ability to upsell. We'll focus on that on the monetisation opportunity. And we wouldn't have global partners and we wouldn't have that enterprise client list that we're extremely proud of if we weren't globally relevant. And as each year continues in our IPO and being listed on the ASX, the ability for us to leverage our position as a thought leader on the ASX, listed with great ability to acquire companies in the past and integrate them financially with a great deal of expertise run by Elise predominantly, has shown that we'll be able to improve leverage from each of those acquisitions, both from a revenue synergy point of view and an expense synergy point of view. There were some elements that obviously were impacted because we couldn't travel to get certain things done and contracts rolling off. But we are seeing large global partners trusting PayGroup as well as large enterprises trusting us. And that channel that we've got with improved with SD Works, we would look to add one more in FY23. And for those shareholders that were meeting us tomorrow, one of the core reasons that we have to do some travel to be able to see that particular new global partner is the reason for to delay some of our meetings. So thank you for your understanding there. So it's trust, it's leverage, and it's certainly a focus on operational expertise. Green arrows, always green arrows at PayGroup, and that's what we're focused on in terms of our outlook. We've had a great FY22. There have been challenges and there are still some residual challenges as a result of labour and deployment of labour in Australia. We expect that. We expect that to continue for a few months on as we are in our winter season. But FY23, our full expectations will be far stronger than FY22. We're not resting on our laurels. Our management team's extremely focused. We've had a great influx of new managers within the company in FY22 to assure shareholders at the C-suite is focusing on those strategic elements, as we've been double-hatting many of those in the first part of our IPO. We're realising some of our sales to revenue targets and will continue to drive implementation to increase revenue. And that is a core focus, both technology advancements and process advancements. We've mentioned earlier that our pipeline is 7 times larger than this time last year, despite record sales. That's attributed to our great technologies, our product and our service, but also because our operations group are delighting our customers every day. And that leads to a significant amount of upsells and referrals. We've invested to grow, and much of the investments, particularly in product, have been done, and we're putting those into a normalisation area and a BAU area. So we'll see some of those heavier investments in FY22 tail off into FY23. We expect a higher contribution from our global partner program. We expect that the 82 countries that we've been able to create as a map will get mechanically more upsells within our client base as they look to achieve their goal as well of one view of their workforce and obviously the integrations into their financial ERPs. Our sales channel is growing well, but we are very diligent and culturally aware of the people that we bring into our sales channel, and we expect them to contribute from very early within their career with PayGroup. So as I've mentioned, along with our technology upgrades and our improvement in our technology stack, we've definitely focused and sourced some key talent for PayGroup. And even though we've materially reduced our cash outflow over the course of the year, we believe a proxy for FY23 is using the last quarter of FY22 and that exit run rate as we continue our goals to be a self-sustaining business. And this ties into obviously our maiden net profit. So when we look at our team members, you've obviously heard and met a lot of us at the C-suite, but our team, which is the next slide that's coming along, will show you how we're very well positioned to continue to execute on a growing ARR, and obviously that correlation between ARR and stat revenue. This is the team that's focusing and making sure that that will happen. There's a massive congratulations to our implementation and operations group on assuring ourselves of that fabulous client retention. But also we're driving transformation throughout our company, both from a values and a leadership perspective. And in the second half of this year, we would look to also review the way that we brand our organisation in terms of our platforms and operating units. There's nothing changing to PayGroup, and we have a terrific focus on our digitisation as well as our transformation throughout the group. Our alliances, both at the inbound sales perspective and the in-country partnership perspective, need a lot of nurturing and a lot of management. But what we do have is an extended rate card from our partners that allow our sales and our operations group to tell our customers that we've got more to offer, and we'll continue to leverage on that improvement of service offerings throughout FY23 and beyond. I've mentioned that our most recent acquisition in the franchise space, which is getting more platform eyeballs onto our superannuation product, is expanding and has leveraged the 82 country partner network. In FY21, when they were standalone, they were landlocked to Australia and New Zealand. So we're seeing more than 20% of implementations happen that are not Australian in that particular business unit. And of course, nothing happens unless we have outstanding implementation processes and product. And that's combined with our team members and in that commercial director and treasury services to always understand when we onboard a customer in our implementation processes, how technology hits the road with our ability to do domestic payments and cross-border. Always realising the goal simply of regulatory compliance and statutory payments to assure that our customers' employees are compliant and happy. We've used the word proud a lot during this presentation. It is actual. It is a proud result for FY22. I'd like to congratulate all of our team members, and I'd like to thank our board for their strategic direction. We've never wavered from our strategic focus on one view of the workforce of our clients and building a SaaS and services business that is profitable and has the leverage and sustainability capabilities to continue to generate more profit as we step along. We're investing time in our leaders. We're investing time in people. We're investing time in technology and absolutely in process. And that further assures our shareholders that we have the right people in the right place to take on our march forward and unlock the full earnings potential of PayGroup and create further value for our shareholders. I'm very excited about FY23 and beyond. I'm delighted that we've put a lot of the complications of COVID-19 behind us in most jurisdictions, and we look forward to a normalised run at how businesses are operating and the digitisation of those businesses as we move forward into our FY23. So a big congratulations to our team and a big thank you to our shareholders for the support. I'll now pass to Dean from Vesparum, who are our IR advisors, to manage our Q&A. Thank you.
Thanks, Mark. Thank you, Mark, Sachin and Elise, and congratulations again on what is a very strong result, and the future looks very positive. Thank you to those who did send in questions. There are a fair few, so if you can just bear with us while we get through them. And if you do have any more questions, please, you can email what was the email address that was indicated in the announcement, and we are happy to try and answer them time permitting. And if not, we can always send them to you afterwards. So to kick things off, the first question is, the contract signed through your GPP sales channel represented 31% of sales in FY22. Can you please provide some colour on where the rest of the new contracts are coming from?
Sachin, please.
I'm happy to take that. Thanks, Dean and Mark. So the 69% is from our direct sales team, and our direct sales team, as I showed you earlier on our LTV CAC slide, is a lean and effective sales team. And they continue to get new logos across corporate, contractor, and franchise, but they're also doing a lot of upsells. And I'd like to point out at this stage that our services operations team, which accounts for 69% of our revenues where they are in services, is tasked with upselling to our clients, and they're actually commissioned to upsell. So when they're on their phone every week, fortnight, a month with the customer, and they notice that a customer may have mentioned that they've got a new country opening, to me, what they do is they inform the salespeople, and then we create that upsell opportunity. So the culture within PayGroup of the 69% sales is all around our direct sales creation, Dean.
Thanks, Sachin. That's probably a good segue then into the next question, which is the strong sales momentum of FY22 continuing at the beginning of FY23? I appreciate some of these questions may have been answered in the presentation.
No, look, we'll announce our sales numbers in the next update we give the market whenever that's due. But the sales momentum has actually already exceeded. If we look at PCP in Q1 of FY22, it's already higher in FY23. And that's because of both that GPP and direct sales. But it's also because we've had continued upsells. So momentum's increasing. And as a person who runs sales for the organization, if my team sold 22.5 million in FY22, you can imagine the targets I've been given, not just myself, but from the board for FY23. So it's going to be another exciting year, Dean.
Yeah, I can guarantee the targets have increased.
Thanks very much, and thanks for that affirmation, Mark. So how do you estimate EBITDA margin to move with revenue growth? Are you guys able to provide an EBITDA margin range for FY23?
Yeah, so thank you for the question. Myself and the board at PayGroup are very clear that the obvious guidance that we're giving is what we've consistently done. We'll see how the year progresses, but the guidance areas that we've given around the translation of ARR to stat revenue is where we'll sit today. However, throughout the presentation and the investments that have been discussed, we are focused on improving EBITDA and NPAT as a team, and that's how our C-suite is also measured and recognised.
Great, thank you, Mark. Is there any new M&A in sight? And if so, what would be the areas of interest, being new verticals, geographies, and/or technology?
Great. So the board has no information memorandums today, so we don't have any new M&A in sight. We are absolutely delighted because we're a customer-first organisation. We've taken many years, even pre-IPO, to understand and exactly strategically present the types of technologies that our clients want. We're very happy with the technology set that we have today. So there's no upcoming M&A. No, there's no focus on technology. If we were to get another transaction, it would typically be, as we've mentioned, questioned, geography. So it's tucking in a client base with an outstanding sales leader that would have a similar type of customer base as ours, but we have none today. Having said that, one of the areas about being listed on the ASX is our deal flow is incredible. We would see something pitched to us every 2 weeks. And as you can see, we're extremely discerning at the board and at management about what we actually pursue. So that globally recognised position is one that's real. And the acquisitions that we've done have always had that hallmark of outstanding founders with the ability to sell and focus on an ASX listed environment. So nothing there at the moment.
Thanks, Mark. And touching on that, there's another question that says, are there any further reductions to come from the full integration of the companies recently acquired?
We've been extremely diligent, and congratulations to Elise and the team about how we've implemented and integrated 5 companies over our IPO journey. So there are some obvious rentals, and there are some obvious other opportunities as contracts expire within the companies that we have, and we've got those organised and well understood from a expense synergy perspective. But our focus is really on the revenue synergies and making sure that, for instance, the franchise sector, which we call the Idea West transaction, can leverage themselves into the 82 countries, and the funds and the master franchise businesses that own those organisations and support that can see that they have growth. And we talked about the KKR-owned IWS client laser clinics as an example of that, where Canada, the UK, Singapore and Malaysia are already live. So our focus is on profitable revenue growth there. There is a natural wind off to the end of the expense synergies.
Thank you, Mark. Next question is, can you elaborate on how and when the company will start seeing profitability, particularly with a reduction in ongoing costs?
Well, I'll pass to Elise there.
We definitely see a focus on getting profitability and growing profitability from this maiden profit reported this year. We're not authorised to provide any guidance at this stage, but as Mark mentioned, the key theme for us in the management team this year and ongoing over the next couple of years is to generate sustainable profit that will create value for shareholders. Thank you, Dean.
Great, thanks for that, Elise. And back to the team, can you elaborate on the customer acquisition cost? When does this cost drop off? And when does the company start to generate a profit from a customer?
Sachin?
Yeah, happy to take this one, Dean. I can confirm that we make profit from our customers. As you saw in that LTV to CAC slide, 15.8 ratio after a target of greater than 5 is a very high ratio. We do sell very effectively with the direct sales team we have. Each sales team member has a KPI of multiple of their cost to the business, and they're measured every month. We have weekly sales meetings where we collaborate on upsells. So from our perspective, we already have profitable customers actually across the whole group. And as we monetize, as we add payments and superannuation monetisation and other upsells into that same customer base, and increase that share of revenue by customer at a higher margin, that'll only improve that customer profitability, Dean.
Thanks, Sachin. The low customer acquisition cost coming through the GPP was touched upon in previous business updates. Mm-hmm. Can you elaborate on the cost to acquire a customer from the GPP versus the direct sales force?
Sure, I'll take that on. Frank Niramban, a board member and Chief of Strategy, is responsible for our global partner program. Essentially, we provide a rate card for the countries and the solutions and SaaS that we have within PayGroup to our global partner program. They then resell that, and we offer no discount or any other incentives, rebates or the like. So literally, once the global partner program contract is signed, the rate cards are shared with that particular partner, their sales force goes to work. So we, in effect, have a proxy sales force across all those organisations as they pursue new business, or as Sachin mentioned, in the case of SD Works, really focused on upselling into their existing 76,000 clients. The process there is we actually get letter of engagements off the base of our master services agreement. with our global partner program, and that goes directly into Chris Brunton's team, head of implementation and operations and technology, goes directly to him for actuation within our implementation and operations group. We have insight into our global partner programs funnel, so therefore we can capacity plan how we're implementing and operating.
Great, thank you, Mark. Thanks for that. Can you please give any details regarding the reduction in cost you can expect going forward after the IT and other spend is done?
I'll take that on for sure. It's a great question. So remembering that we're operating in a complex regulatory environment, so as countries, particularly with a focus on Australia and New Zealand, change items to do with payroll and people, which is always the move. There's always change, but we have an embedded expense within our IT product team. Where we're seeing a reduction is around the innovation area, because of our significant projects, 3 have actually gone live. So as a result of that, that moves from innovation into business as usual. So we will see a reduction circa 5 to 7% in FY23 versus FY22 as a result of those. And as our other projects, which are operationally leveraged focus, go live, and the innovation team members hand over to our business as usual group, particularly based in India, we'll see ongoing reductions. But remembering that is obviously determined against a fast rising revenue base with a 7x sales pipeline, and again, sales before expense will focus our IT expenses on ensuring that we implement profitable contracts.
Great, thank you, Mark. Do high interest rates help revenue? And also, what gross margin do you expect when the company is more mature?
This question typically comes from somebody that's globally aware that our peers in the US can make money from interest rates because of payrolls that are paid to us that we domestically or cross-border move. They can earn interest. Sadly, in APAC, we don't have that regulatory allowance to do that. So interest rates don't affect the float monies that we hold on behalf of our clients as we pay into their employees' bank accounts and the pension funds around the region. So if the interest rate question is pertaining to that piece, no, we don't have that opportunity in Asia Pacific as opposed to our peers in the US.
Thank you, Mark. And we have time for one last question. So thank you to everybody who has sent in questions. And for those that haven't been answered, we will get back to you privately. So thank you very much, everybody. The last question is, how much as a percentage of revenue is the SaaS-driven revenue?
We've described that before.
Yeah, the SaaS is 31% of our revenue. I think it's in note 3 to the appendix 4E. And that's consistent to what we've, had that 70-30 revenue between services and SaaS historically. And that theme continues. And as we upsell more of our HCM across our existing customer base, we might see a small uptick in that theme.
Thanks very much. That closes the Q&A. Mark, back to you, please, for our closing.
Thank you very much again to all of our shareholders and potential shareholders for joining us today. And again, I extend my big congratulations to the PayGroup team members on FY22 and assure everybody that our growth on profitability and operational leverage and I think our cash management is our core focus for FY23 as we continue our journey to delight our customers. Thank you very much.